We notice investors buy closed-end funds for many different reasons, from income production to manager diversification to a host of other reasons. At Matisse, we're primarily after alpha, that is, outperforming benchmarks over time. So we wanted to know, can we, with a portfolio of closed-end funds, produce alpha that's sustainable over time? And when we researched this, we found that there wasn't a lot of research available. We went back and we studied closed-end funds from every possible angle, looking at expense ratios, looking at performance of the funds on a trailing basis, looking at a host of factors, dozens of factors. And we found that none of these factors consistently created or led to outperformance going forward. But there was one factor that led to outperformance, and that was discounts. So buying funds at tremendous discounts to NAV, it turns out, leads to outperformance. Not for every fund, right? Not all the time, but in the aggregate, it leads to a lot of alpha. How much alpha? Well, we studied closed-end funds back to 1988, where we have good data, and we found that if you buy a portfolio of highly discounted closed-end funds, those discounts narrow, on average, by 1% in the next month. So that kind of alpha is tremendous. And that's a source of return. It's a source of alpha that's independent somewhat of the underlying portfolio performance. So we launched our firm basically based on this idea. And we've been running portfolios for 12 years in this strategy. And we've produced 2 to 4% alpha after fee to relevant benchmarks using this idea. So what we found in our initial historical study has continued to hold true, and that's that the discount capture that we've been able to achieve is directly explaining our outperformance. Well, there are always closed-end funds that are on sale. They get on sale for sometimes one-off reasons, but occasionally entire sectors of the market go on sale together, and that's true today. So today, there's 2 distinct areas of the market that are on sale. One is international equity funds. And these funds trade on average at 9% discounts to their net asset value. And this is wider than it's been for quite some time. Another area that's even more discounted is municipal bond closed-end funds. So these funds, there's a collection of 79 state-specific municipal bond closed-end funds in the universe. And today they trade at 10%. On average, discounts to their NAV. The same group of funds, on average for 20 years, has traded at an average 3.5% discount to NAV. And there's only 2 months in history when these funds have been this cheap, November and December of 2008. So these are great opportunities, and they make up about 1/3 of our strategy holdings. Areas of the market don't go on sale for no reason. Big discounts happen. And if you look at international funds, for example, there's a key reason that people don't like international closed-end funds. For example, since October of 2007, well, the S&P 500 has returned 137%, right? The MSCI EAFE index has returned a total of 13%. And the MSCI Emerging Market Index has returned precisely 0. So investors have been fleeing those spaces, and that's reflected in tremendous discounts for these funds. Now we think that these things will tend to reverse. So the US dollar is very strong. It's so strong that in many cases you can convert your US dollars to a foreign currency and buy twice as many goods in that country than you could buy here in the US. This is called purchasing power parity, and we think that this is going to cause foreign currencies to strengthen going forward. Mean reversion is a powerful impact in those areas. Similarly to municipal bonds, municipal bond closed-end funds appear to be on sale because the treasury rate has spiked to 3% and people feel it's going to go higher. However, if you look back at the last 7 years, we are at a high for 10-year rates. And while, sure, the economy could continue to improve and rates could go up, we're at 9 or 10 years into the longest economic expansion in US history. So any decline in the economy could definitely take rates down back to normal levels. It's also the case that there are powerful secular reasons, demographic reasons, and the fact that the world is awash in debt, really, that could keep a lid on rates for many years to come. So we think that these discounts are not really going to persist because these factors will change going forward. We've been running our strategy for about 12 years, and we have about 2 to 4% after-fee alpha versus various relevant benchmarks. And the important thing to note there is that that alpha is entirely traceable to the discount, the gap between the discount at which we purchase funds, which has on average been 13% or 87 cents on the dollar, and the discount at which we sell funds, which on average has been about 9.5%. So this gap, we've been able to actually capture this discount movement in a systematic way, and this is responsible for our alpha. We also launched a mutual fund, MDCEX, in 2012. So we have a fund with a almost 6-year track record, 4-star fund in the tactical allocation category.